Hello, my name is Bella. I'm the host of Beyond Now, and today we have William Houston and Katie Wei from Bay Street Capital Holdings today. Thank you very much for accepting my invitation, and thank you for coming all the way through from the other side of the world.
Thank you very much.
Of course, thank you.
Okay, so to start, for those who are might be not familiar to the concept, how would you simply define the quantum mental investing, William?
So quantum mental investing is a mix of quant and fundamental analysis. The simplest way I like to think about it is quant is something like math, whereas quantum mental is a method that you use to accomplish that math, or how you think about using and manipulating that math, right? Quant is looking at, something in the past. You're looking at backwards data. Quantum mental is how do you create a framework to apply that and predict the future outcome. So when it comes to investing, our view on investing is that you should take a data-driven approach, but you should also be looking at the fundamental framework of the investment that you're making. And when you put those two things together, you're able to build a portfolio that from a risk-adjusted rate of return standpoint is going to be compelling for investors that want to not just know, is this a good investment, but is it the right investment for my portfolio and for my risk tolerance? Yeah.
So for Bay Street Capital Holdings, what specific tech tools or ways to manage data, skilled people are most important for building and keeping your quantum mental investing approach very strong, like the Bay Street Terminal?
I would say, yeah. So Bay Street Terminal is a quantum mental proprietary framework that we built. Essentially, it's an investment platform, and we use it to score assets, private or public, deal by deal, and also compare them across the board. Essentially, the question we're asking is whether it's say a REIT in Singapore versus a private debt deal in Lisbon. We are asking the questions: does this meet our conviction threshold?
In practice, how does Bay Street Capital Holdings ensure that the fundamental human insights truly complement rather than conflicting with the signals generated by the quantitative models?
So I think in practice, what we're looking to do is make sure that we're not relying on our intuition or our gut feeling when we're making investments. One of the problems that Katie and I saw in the private market space is that a lot of the opportunities are very unstructured. They're opaque and they're unregulated. And since we had been successful in the public markets, we wanted to create you could say, equivalent approach when in looking at private opportunities. And something that we had as a pain point as investors was that it was very difficult to tell and to compare opportunities to one another across multiple jurisdictions. And so we wanted to be able to look at any sort of asset, as Katie alluded to earlier, and have an idea of not just is this a strong and compelling opportunity, but how does this compare to everything else that I've ever looked at with decades of data in the public market that we knew how to manipulate and understand, and transfer that over to the private market.
So what initially led Bay Street Capital Holdings to adopt a quantum mental approach as a core part of your investment philosophy? Was there a specific aha moment, or was there a condition that you needed this hybrid strategy?
Yeah, so both Will and I came from public investment background. And so we've been thinking about how can we actually leverage our public investment background into private deal selection and investment, such that because we do see some overlapping similarities between the two, because essentially we are evaluating a business. So then we came up with this idea and combining quantitative analysis with the fundamental knowledge, market knowledge, such that we will combine the both worlds, because we have the quantitative, you can say quantitative clarity and fundamental depth, so that we are able to integrate the public market signals with the private deal intelligence to really make informed investment decisions.
Yeah, I think at the end of the day, we wanted to be able to justify why we were making decisions. One thing that's very difficult to do is raise funds. And, something that I've always told Katie is, regardless of how things turn out, I want to be able to stand behind a decision that I've made. And something, again, that was very frustrating in the private markets is that although you were receiving lots of data, how you would compare that data to other opportunities. And so Some of the things that we did, like for example, in the private space, you have illiquidity. So we wanted to actually quantify what is the illiquidity, how much is that going to cost, and how much should I require as an investor for the additional yield that I'm going to get and for the additional alpha. And so what we decided to build was a framework that would allow institutional investors to get exposure to an asset class that historically has been underallocated to and misunderstood. Less than 2% of institutional investors invest in hospitality.
So what initially led Bay Street Capital Holdings to adopt a quantamental approach as a part, like core part of the strategy, investment philosophy? And what was a moment that you thought we should adopt this, or was it like a market condition that you needed this strategy to behold?
So what Katie and I wanted was a process that had a lot of rigor as opposed to randomness. And something that we saw with these private opportunities is that there wasn't really a framework that we knew of that we could apply to make defensible investment decisions. So everything that we built was a function of a pain point that we had as investors, where we wanted to be able to not just diligence an opportunity, but have a lot of clarity in that decision and a lot of certainty over the outcomes in a market that is typically very opaque and misunderstood by investors. Yeah.
But how would you define and manage the risk?
So we start with something called Bay-adjusted Sharpe. The Sharpe ratio is basically risk-adjusted rate of return. And we're trying to determine for each additional unit of risk, what is the return that I'm going to see in said investment? And we would compare any opportunity that we have with the universe of other investable options. So should I invest in this hotel in France? Should I invest in this hotel in Australia? Or should I just buy Marriott stock, right? Being able to compare any public or private opportunity, either whether it be a portfolio or a REIT or an individual asset. Now, when I look at the investment, I've got more clarity in the decision that I'm making, and I've got a larger sort of understanding of, is this the best use of my capital, right? And if it's going to be an illiquid asset, once you look at the Sharpe ratio, we built something called a liquidity stress delta. So if something were to go wrong with this private deal, how is that going to affect my internal rate of return if it's delayed by 12 months, right? We also built something called adjusted hospitality alpha. And what that is showing us is, what if we are in this asset and there's some sort of illiquidity premium? It's defining what is the cost of that illiquidity so that we can bake that into the returns that we're expecting at the time of the investment. Yeah.
I just wanted to ask Katie that how does that translate into risk-adjusted returns limited partners care about?
We evaluate deals integrating the investment risk and also liquidity risk, such that we will look at what is the different kind of exit scenarios, and look at, like, from those exit scenarios, what would be the, like, different IRRs. And then so when we optimize for the portfolio, we don't just optimize for the best IRR, but we optimize for the most defensible risk-adjusted returns. And then we also, we also look at, for example, for different scenarios, what will be different type of IRR for different kind of delays. And then so that the LPs, they can have a portfolio that is within their target risk and reward bands across region, strategy, and structure.
So who do you think would be the right kind of investors for Bay Street Capital Holdings?
So our view is that hospitality is global, and we've built a platform for global investors. So it's meant for individuals who are looking to diversify away. Say they've got the majority of their investments in one region, and they want to diversify out that risk. It's meant for investors who like a data-driven approach to investing. Our view is that capital follows conviction, not citizenship, right? So we don't have a home bias. Although we are based in the U.S., our fund is based out of Singapore for various reasons that are to the advantage of our investors from a tax standpoint.
And recently you've been in Dubai, right?
Yes, we've been around the world. Yes, we were in Dubai for 24 hours. We had very good outcomes there with, again, families that are looking to diversify out of the region or to allocate in the region. And there's a lot of incentives for foreign direct investors that are coming in. And so it makes the investment more compelling when you've got the support of governments through foreign direct investment incentives, economic development, tourism development, and sustainability, right? So absolutely, you know, the platform is meant for institutional investors who want to take a risk-adjusted approach to their capital and don't want to have the isolated risk of a one-off property, because we're investing at the holdco. So we're getting exposure to all of the assets that are already built and all of the future assets that will be built in the future, or we're directly investing in the operating company that's currently managing a block of assets and will manage a block of future assets as well. Yeah.
About the structure of the investment, how does it go? Deal by deal or versus like fund?
Yeah, so we invest out of the Bay Street Hospitality VCC out of Singapore, and we have the flexibility to structure it deal by deal or like an anchor commitments. And essentially, we first of all, like when we identify like the right partners with the right profiles and opportunities, we will be able to scale selectively and underwrite effectively.
Okay, so with the rapid growth of AI and machine learning, how do you see these technologies further shaping the future of continental investing over the next maybe 5 to 10 years in real estate?
So as we mentioned, we came from the public markets. You know, in the public markets, you use something called a Bloomberg terminal. We have a view that hospitality and private assets in general are entering into this like Bloomberg terminal era, right? So what we built is the Bloomberg terminal for hospitality assets. We have a view that not just us as investors, but sort of the general market is going to start moving towards more data-driven decisions. And a lot of the legacy platforms that provide data are going to start, again, kind of back to this quantum mental framework. They're going to go sort of beyond data, and they're going to start moving towards predictive outcomes based on trends and based on momentums, not based on moments of time. So typical data today that you can say, okay, what happened 3 months ago in a sub-market? I think now what investors are looking to do is predict what's going to happen 3, 6, 9, 12 months from today in this region, because I've got decades of data that's unstructured that can be fed into a platform, and that model can spit out what is the most statistically significant outcome if I were to deploy my capital here over the next 1, 3, 5, 10, 15 years, you see.
Thank you very much for your time today, and thank you again for accepting my invitation.
Thank you as well.